Welcome back. Top story in business this morning. Oil field services giants Halliburton and Baker Hughes calling off their highly contested merger following oppositions from the Obama administration. The regulators claim the deal, once valued at nearly $35 billion, would hurt competition in the space. Halliburton will pay Baker Hughes a $3.5 billion breakup fee to compensate for the collapse of this deal. We want to bring in Field Point Chief Investment Officer Bill Kennedy. Phil, good to see you. Thanks so much for joining us.
Thank you.
And part of the reason to invest in equities over the last couple of years has been a huge, rich merger backdrop. You're seeing companies acquire other companies for growth. But now it feels like the administration is coming out with more rules to stop this, to pull it back. Is that how you see it?
I do. I think really what's driving the slowdown in M&A for this year is a saturation of debt. So a lot of corporate America's balance sheet has been indebted. We're seeing the growth of debt last year on corporate balance sheet was materially higher than GDP growth, for instance. So I think it's just more difficult to get justification to go through with some of these M&A mergers and M&A activities. But what's terrible about this is the fact that you have the regulatory environment really burdening corporate America at a time when corporate America cannot grow their top line organically. So they're looking for ways to grow on the top line. Mergers is one of the ways to do that, but it's making it difficult out of Washington, D.C.
It's funny because it almost feels like, Michael, the administration it doesn't want these companies to grow that way. You know, I mean, look what just happened with Pfizer and Allergan. Putting more rules, heavy fees on companies if they consider acquiring somebody outside of the U.S. and moving headquarters. They don't want them to grow that way.
They're stifling evolution in this respect. You know, they're thinking very short-sightedly. They say, we're going to save jobs. You're not going to save jobs longer term if you're stifling what's going to go on. Jobs are going to go away. Jobs will leave the country. They'll go to corporate entities in countries that are more friendly to this sort of thing. There's so many ways that Baker Hughes, Halliburton could have happened, and the regulators just would not allow. But it's also
at the state level. I'm a resident of Connecticut, and GE just went to the People's Republic of Massachusetts.
That's right.
Who would have thought that would ever have happened? And it's continuing with other companies thinking about moving.
Good for them for having the guts to do that,
rather
than putting up with it. But we always say, and this is not in the abstract about the regulations out of the Obama White House, that you've had the administration take a shotgun to the healthcare industry, to the financial industry through Dodd-Frank, re-regulated the internet, put coal out of business almost, and then in terms of economically sensitive regulations or ones that have an economic impact, it's 392 in 7 years, and that's more than the 2-year terms of President Bush and President Clinton.
Yeah,
so
true.
This is reality. Yeah. This is not fiction.
Absolutely.
What's going on in the healthcare industry right now with the insurers walking away from ACA right out of Ayn Rand novel?
Yeah.
It really is. They're saying,
so
okay,
universal.
we give up. See you later.
Because it's too expensive.
That's it.
So the costs around the tax code, around the regulatory environment in general in terms of deals has been so onerous that it's very difficult for companies to grow. So having said that, Bill, how do you allocate money today in a market that you've got companies basically having a real hard time growing?
So, first of all, there's policy on everything we just discussed is policy uncertainty. So that puts a higher burden for investors who are trying to make money in this market. But we're at that point in the earnings cycle where you're starting to see margins rolling over, but earnings growth, EPS growth is rolling over as well. It's a very, very critical time, we think, in the markets. For that reason, we're actually underweight U.S. equities. However, within equities, there are small pockets where we think there are opportunities. We still like REITs, but we think in mid-cap and value as opposed to growth style is another place where should outperform, we think, over on a 12
Value outperforms over growth.
Value outperforms over growth, and mid-cap outperforms versus large cap.
Yeah, because, I mean, when you look at the tech and the growth story over the last couple of weeks, technology has had a hard time, Michael. I mean, Amazon did really well, but other tech names have not. So there's the growth story that underlines what you're saying.
Well, and Apple looks more like a value company now than a growth company.
You're right.
So you can
it's being painted as such by that. Yeah, one issue that I personally have with the value thesis is a lot of folks came into the year, they liked value. A lot of it had to do with the Fed hiking rates 2 to 4 times. I don't think that's going to happen now. Consensus has come around to that. How does the Fed factor into the value decision for you?
Yeah, it's really more on a macro thesis. We think the Fed's on hold maybe until December, but it might even be into 2017. And where it transitions into the economy is really through the dollar. So by the Fed becoming much more dovish, the dollar has weakened. That's actually been positive and should be positive for GDP growth and earnings growth. Our base case is that we can still squeeze out 2.5% GDP growth for this year. Earnings growth sort of 7 to 8% for the S&P 500. However, if we do start to see inflation picking up, and we do think that is a possibility, wages are rising, you're going to see a commodity base effect in the second half of this year, credit is still expanding. We think we could have a bit of an inflation surprise in the back half of the year where the Fed does raise rates. That's going to shoot the dollar back up. And that expectation for 8% earnings growth is going to be closer to zero as we go into 2017. Our base case is that 2017 will be a recession in the U.S.
Wow. So any expectations for the jobs numbers coming out at the end of the week? I think the estimate is 200,000 jobs for the month of April.
We think they'll be pretty close. I would say 200,000, but to us, we have hit peak jobs. And jobs are a lagging indicator.
Interesting, because the recession fears have begun to recede, but you're saying, no, it's still on the table for 17.
I do think so. I do think so.
We'll leave it there. Bill, good to see you.
Thank you very much.
Thanks so much for joining us this morning. Bill, joining us this morning from Field Point, Bill Kennedy.